Ladies and gentlemen, good afternoon, good morning, or good evening, depending on from where you are calling. Welcome to the Global Interdependent Center's virtual event titled, Is Productivity Dead? My name is Bill Kennedy. I am the Vice Chair of Programs for the GIC and your host and moderator for today. On behalf of the GIC Board of Directors, let me welcome all of you to our first virtual event of 2020. So a few housekeeping items, if I may. First, after our speakers' prepared remarks, we will open it up for questions. If you wish to ask a question, please select the GoToWebinar link that was included in your confirmation email. Go to the questions section of the webinar page, type in your question, and the GIC staff will get your question to the panelists. Second, to access the presenter slides, you can click on the links that were embedded in your confirmation email. Alternatively, you can simply log in to www.interdependence.org, click the Resources tab, then go to Event Resources, and you'll find the slides posted. While you're in the GIC website, I encourage you to take a look at the excellent lineup of events that we have scheduled for the first half of 2020. This includes our February 3rd conference in La Jolla, California, titled Big Data, Machine Learning, AI, and Digital Money. If you're more of an East Coast person, please join us on February 14th in Sarasota, Florida for the 4th Annual Financial Literacy Day, sponsored by the GIC and Cumberland Advisors. Finally, if you're not yet a member of the GIC but would like to become one or learn more about membership, in the GIC website, click the Become a Member tab in the upper right corner. Here you'll learn about the GIC's important mission and the great member benefits, including access to our programs and forums. Check it out. I think you'll find membership to the GIC highly productive. Speaking of productivity, and without further ado, I'm pleased to introduce our two panelists. We have Don Rissmiller, who is a founding partner of Strategist Research Partners based in New York. Don serves as the chief economist, and he's also the chairman emeritus for GIC. And Jeffrey Korzenik is the chief investment strategist and senior vice president at Fifth Third Bank based in Chicago. So why are we discussing productivity today? One notable feature for global growth since the great financial crisis has been below average labor productivity growth, and that has led to structurally lower GDP growth. It matters if you are a new normalist, or if you're a secular stagnationist, or if you're a modern monetary theorist. However one labels it, they all roads lead back to the collapse of productivity growth. So we thought it was an opportune time to explore the reasons behind this, provide a careful study and understanding of both the cyclical and structural trends impacting productivity as it matters for investors, economists, and policymakers. So with that, let me start, Don Rissmiller. Maybe you could kick off by defining what we mean by productivity and let us know what cyclical factors you're focused on.
Okay, happy to do so, Bill, and welcome everyone on the call. I'll reference the slides that I have here by page number so you can follow along if you've clicked that on the link or gone to the website. So I'll talk about what we mean by productivity, how we calculate that, typically in this space, how that plays into aggregate wage measures, and also how that can matter for calculations of corporate profits. So if you look at page 2 of the handout, one of the primary sources we use is data from the government in the U.S., where we look at real output per hour, and this combines some of the factors from the National Income and Product Accounts, as well as the Bureau of Labor Statistics. So we can take GDP as a starting point that comes from the national data. You can break GDP down into the business sector, the household sector, and the government sector. And so one way we like to look at productivity is to zero in on the business sector, and in particular to remove volatility, to look at the non-farm business sector number. So if you take the data that's released by the Bureau of Economic Analysis, you can get a subcomponent that is the gross value added for non-farm business. You can get a quantity index that puts that in real or inflation-adjusted terms, and you can think about that as forming your numerator, forming your output calculation. Then you can go over to the Bureau of Labor Statistics, and you can get an aggregate weekly hours index. You can see that number for private industries all in. That's starting to form what's in your denominator. But you want also to include some measure of self-employed. And so you can also go over to the survey data, and for the non-agricultural sector, get the number of self-employed workers. You can look at the average weekly hours for that non-agricultural subset and let that form what is in the denominator of this calculation. And so this is going to, if you look at page 3, give you a picture of the non-farm business sector real output per hour of all persons. Now here we're charting it on a year-on-year basis. You will notice that this chart has that SA in the title, so that's seasonally adjusted. So for a year-on-year growth rate, that's not overly important because there's an implicit seasonal adjustment in a year-on-year percent change. But the other way you might see this statistic reported in the press, for example, is on a quarter-to-quarter basis, and it's usually expressed at an annualized rate for the U.S. data. That's not always true for other countries when you look at the national accounts. But for the U.S. data, you would think about that quarter-to-quarter number as requiring that seasonal adjustment process. So that's meant to take out any of the normal ebbs and flows over the course of the year. So a couple things we want to consider with this measure. Is this the only way to calculate utility or what we're getting out of the economy? And the answer to that is clearly no. There are other considerations beside this output per hour calculation. However, if we restrict our discussion to productivity defined this way, we're going to be able to answer some important questions about how we're doing relative to the debt we've accrued, relative to things that require income to be paid. And so you can see, looking at this chart, that this does bounce around, that productivity defined this way, even on a year-on-year basis, has some natural volatility to it. But if you look at the beginning of the chart in the late 90s, even up until about 2005, productivity on an output per hour basis was trending around 3% here. We've had a different story since about 2011. Now, there are cyclical and structural factors. So if you look at that big surge in productivity after the shaded bar around 2010, you can see that there was a pickup in output per hour coming out of the last recession. The shaded bars here are those recession periods in the U.S. as defined by the National Bureau of Economic Research, NBER. So it is typical to see a cyclical move coming out of recession. In fact, you could say that this is finally what pulls you out of recession, is you get a change in the economic structure that gets a boost in productivity, that puts a floor in profits, that puts an end to layoffs and things like that have affected the economy. But what we've had since then is productivity that's averaged at a much lower number. You can see we're hovering around 1%, just a touch above that more recently. So we used to do 3, now we do 1. And that issue, that slowdown in productivity, really started before the last recession. So the recession was deep, that mattered. But this has been going on since about 2006 or so, maybe not quite as extreme as we've seen in recent years. But this has been something that's been developing for quite some time. So if you look over at page 4, it's unlikely that the slowdown that we've seen in productivity growth is just cyclical based on the timing that we've seen. Another way to look at this is something that's gone on in many different countries. This is not just a U.S. phenomena where we've seen this change in the productivity growth rate. So there are a couple different ways to discuss this. One would be that it takes some time for technology to get the business process. So because we're focused on the business part of the economy, we need the technology that is in the economy to affect business process specifically, and that could be something that evolves over many years. It's also possible that the structure of the economy matters here. So the fact that it's a service economy versus a manufacturing economy in the past. So economists like Robert Gordon or Tyler Cohen have talked about this. In a service economy, there may be things that are harder to improve on an output per hour basis. So it's hard to play a Mozart quartet with 3 people, as an example. You don't necessarily want a doctor to see you for less time and call that a visit. You don't want a teacher to lecture for 37 minutes and call that an hour lesson. There are just some things in the service economy that are harder to improve on an output per hour basis, but not impossible. You could think about health records or places like that where there are avenues to do this. Another issue is why we need this type of growth. So why are we so focused on getting output per hour up? And if we had no debt in the economy, then I think the story could be somewhat different than what we've discussed thus far. And debt, I mean not just bonds or those type of financial instruments, but debt meaning obligations to future individuals. So that could be entitlements, that could be promised medical benefits, that could be things that you've promised as income in retirement, like Social Security, things that you believe you are owed. And so a lot of the debt was structured with an idea that growth was going to happen. And I'd say that's where the productivity number, especially the productivity number calculated this way, becomes important, because this number that we're talking about is coming out of those national income accounts. And it's going to be that income that is going to provide the debt service, the ability to deal with those obligations that have been created. Another issue, if you go over to page 5, is that productivity becomes an important factor for profits, and it becomes an important factor for wages. So one way to take the data we get on output per hour in the non-farm business sector and use it is to look at it relative to wages. And when you take the wage number and adjust them for productivity, you get this series called unit labor cost. So you can think of unit labor cost as a productivity adjusted wage series. And you can see when this number gets above 3% on a year-on-year basis, if you look back before those two shaded bars, you start to see more end-of-cycle characteristics. So a way to think about this is rising living standards, which are supported by productivity and supported by wage increases, become sustainable when you also have this type of offset. So you need productivity up as well as compensation up to net out and to allow profits to grow as well. And so productivity can help make the pie bigger. So if productivity is growing, you can pay labor and capital instead of paying labor or capital. And that's the pathway to a sustainable business cycle. If you look at page 6, then we can tie this one more step into the profits equation. So the solid line here on page 6 is corporate profits from the national accounts. There are a few inventory and capital consumption adjustments which allow the data to be summed up. But this is a year-on-year growth rate in corporate profitability. Again, an important input into the business cycle. You see what happens before those shaded bars is profit growth goes negative. Now, a factor we can calculate using that unit labor cost variable we just discussed is the price cost difference. So if you take inflation and you subtract the unit labor cost calculation we have, that's that dotted line on a year-on-year basis back historically. And you can see the correlation between the price cost markup and the profit picture. So if you can't raise price, maybe the Fed is fighting you, maybe the market is fighting you, maybe the end consumer is fighting you, and you have some cost pressure, that's where you get the conditions that look more end of cycle. So productivity, by making the pie bigger, is the recipe going forward for the sustainable cycle. It's an important factor for profits, and it's an important factor for the long run increase in living standards. And I say calculating it with this type of data gets you to an answer that helps make some sense of this data. It's not necessarily addressing happiness, it's addressing the income side. So it's not really a utility measure all in. But done this way, it's going to address what is our ability to generate income. Can we keep that going? Can we service the debt that we've created in the economy thus far? So with that set up, let me turn the call back to Bill, and we'll continue.
Great. Thank you, Don. So again, if you would like to submit a question, please go to the GoToWebinar link, the question section, and type in your question, and we'll get it to our speaker. So Jeff, let me turn it over to you. You've done a lot of work on demographic issues and labor issues, a little bit more structural in nature. How do you think about the productivity question?
Yeah, and I think there's a good tie-in. Don raised some very long-term concerns for the U.S. economy and the importance of gaining long-term productivity growth in the economy. And that gets involved in a lot of structural issues and demographic issues. I'll ask the listeners to pull up and go to page 1, and we'll start examining what we believe to be important long-term drivers of productivity. Over the short term, capital investment tends to be the most important factor, but that's cyclical. There's some long-term trends that I think will give ultimately support to better productivity growth ahead in the U.S. economy. And the first has to do with U.S. Rates of entrepreneurship. And the chart you'll see on page 1 shows data we get from the Global Entrepreneurship Monitor that shows entrepreneurial activity, early stage entrepreneurial activity in the U.S., that's the green line, versus other major developed economies, Germany, France, Japan, and the UK. And you can see that U.S. entrepreneurship has traditionally been above the rates of entrepreneurship in other major developed economies. During the Great Recession, there was, and leading up to it, there was a declining trend in entrepreneurship. We believe this is related to some of the loss of productivity gains as well. Entrepreneurship comes into play in that if you think about the ways that entrepreneurs survive, it's by offering a good or service to others that didn't exist before, and that's inherently in many ways associated with productivity gains. You're able to beat out the competition, secure a place through offering something of value, and that relates closely to productivity. It also relates to productivity in that the ability to commercialize innovation is also often linked to entrepreneurship. Don mentioned earlier the lag time that can occur between development of technologies and the business community adopting those technologies. Entrepreneurship tends to be a driving factor in that. So as you can see, that entrepreneurship in the U.S., not only relative to other developed countries, but also just in absolute numbers, has been surging to the highest levels in a generation. What I think is also interesting is something that's not displayed on this particular chart, but data we get from the Kaufman Foundation for Entrepreneurship in Kansas City, which breaks down U.S. entrepreneurship rates, new entrepreneurs by race or ethnicity. One of the reasons that the U.S. entrepreneurship is surging has to do with this breakdown. The Latino population in the United States continues to grow as a percentage of the overall population, and the Latino population has been exceptionally entrepreneurial. Of the groups that the Kaufman Foundation tracks, Latino, Asian, Caucasian, and African American, Latinos are by far and away the most entrepreneurial culture, and entrepreneurship is linked to culture. And that is one of the reasons that we're seeing this surge in U.S. entrepreneurship. The other reason has to be with a traditional lagging entrepreneurship rates, those of the African American community. Over the last 3 or 4 years, there's been a surge in entrepreneurship in the African American community. No one's quite sure why. It's probably no doubt due to confluence of some longer-term trends in household capital formation and educational attainment, but we also think it may be tied to the gig economy, the Uber effect, getting people who had not been entrepreneurial into part-time gigs that force them to think like business owners, and that encourages ultimately entrepreneurship. Whatever the reason, that's very good news. You can't have 13% of your population, the African American community, not being very entrepreneurial and have an entrepreneurial society. They've caught up. Their rates of entrepreneurship are very similar now, or roughly the same as the Caucasian and Asian communities. That's good news for the overall U.S. economy to the degree that we believe this will drive productivity growth. There's another demographic factor that we think is quite important and will be very beneficial for the U.S. economy in terms of productivity growth in the years ahead, and that's the relationship between productivity and age and time in the workforce. We do not have good data that measures productivity of the average worker at any point of age, But we have a very good proxy for that, and that's in earnings. You earn more money by being more productive. And if you look on page 2, slide 2, the embedded productivity gains, that starts out in the title saying, "Thank you, millennials." We believe that the large millennial cohort in the workforce, the largest cohort in the American workforce, will drive productivity gains over the next 10 years. You can see in the data on this slide that different age cohorts have different median weekly earnings. But what I'd ask you to observe is where the big leap comes. If you look at that 25 to 34-year-old elite, if you're a parent of millennials, as I am, our observations are correct. Millennials are not very productive, and they don't command high earnings. But the baby boomers and other big demographic surges were the same. When you move from that 25 to 34-year-old age cohort, you pick up experience, career focus, sometimes social networks that drive ability to be more productive, a whole host of factors. The good news is that big surge comes from the 25 to 34-year-old group. When you move into that 35 to 44 age cohort, if you look today, the millennials are the largest cohort in the U.S. workforce. The millennial birth boom peaked in 1990, so we have a whole bunch of 30-year-olds and a somewhat bell curve-shaped distribution around that. So we're right in the middle of that first bar on this chart, but over the next 10 years, that group will move forward and into the next cohort, which commands greater earnings because they are more productive. We saw that, we believe that was an influence in productivity gains in the 80s and 90s with the baby boomers. We believe that will positively influence productivity gains in the next 10 years. The final factor, and I'll ask you to turn to page 3, is both a cyclical and a secular factor, and that also relates to the labor force and the ability to become more productive. Some of that is simply the ability of workers to move into roles that allow them to be more productive. But that requires workers to be able to leave and willing to leave positions. We have a measurement of this called the quits rate. It's part of the JOLTS report, the Job Openings Labor Turnover Survey that's put out by the Bureau of Labor Statistics. And you can see that this has been rising, as you would expect. If you look towards the middle of this chart on page 3, during the Great Recession, people are very unwilling to quit their jobs and move to other positions. A, because many times those positions did not exist, and B, there is a fear factor when economic conditions are poor. But the quits rate has been steadily rising. We know that from other data sets, we know that people who quit their jobs and move to another firm are able to command greater pay increases. They're commanding greater pay increases on average because they are in roles that allow them to be more productive. So this is a good sign to see this quits rate moving higher. It suggests people can move into higher productivity positions. But I think there's a lesson for this on a structural basis as well. And this is that we need to be able to have our workforce more flexible, more able to move. There's been some data that suggests that people are less willing to move geographically than they have been in the past. That is a weight upon productivity growth. People can't move to higher productivity positions. But what we've been particularly interested in at Fifth Third has been other kinds of barriers. Education mismatches are one. I think we have that going on, saying manufacturing. Manufacturing jobs on average tend to be higher paying and higher productivity jobs. The last monthly labor report for the month of December showed a decline in manufacturing jobs of 12,000. At the same time, there were 477,000 job openings in manufacturing. That suggests that we have some challenges in labor mobility, at least in this sector, either training mismatch or geographic mismatch, or perhaps the pay just hasn't quite reached the proper equilibrium. We're also very interested in other kinds of barriers to allowing people to be more productive. There's a link in the last email that was sent out that links to an op-ed I had in this week's Chicago Tribune. It was in the Tuesday paper edition and online earlier. That talks about the barriers that people with criminal records have to full employment. We have, for reference, 19 million Americans with felony convictions on their records. Of those, less than 2 million are actually currently incarcerated. Not all are working age, but that certainly gives you a sense of how many are out there. Having a felony or even a misdemeanor conviction is a huge barrier to workforce mobility. We have a little bit of a measure of that barrier. There's a new study out from the University of Michigan that will be published in the Harvard Law Review that compares the income of people who have gone through expungement, essentially the hiding of those criminal records before and after expungement. And so that gives you a sense of the talent ability, the productivity contribution that workers can make, and what happens when you remove that particular barrier. The study found that over a 2-year period, the same individuals before expungement and after expungement over 2 years gained 20% of their income, which suggests that labor mobility related to barriers, labor mobility barriers because of criminal records have a profound economic impact. And this will be something that we think is being looked at very closely on policy levels, and obviously we're doing our own research. With that, why don't we turn it back over to Bill?
Great. Thank you, Jeff, and thank you, Don. So again, if you'd like to ask a question, please do so online. And Don, let me ask you just to kick off. You clarified for us that productivity growth used to be 3%, now we're at 1%. Can you talk about the global trend, global productivity? How do we think about the move from 3 to 1% in the context of what's happening overseas? And are the drivers and the factors the same? Could you speak to that?
Yeah, sure. So I think it's pretty clear some of the factors are going to be the same. So we've seen a slowdown in productivity in other countries. We can look at certain economies where productivity has not been very good at all. The productivity growth rate in Italy, as an example, has not had significant growth for quite some time, many years. And so certainly the political system matters. But generally, if you look at the U.S. or the UK or some other economies, you've seen a slowdown in productivity growth. And that's where some of the factors like being more service-oriented or not do seem to play a role. But this has been a trend in many developed economies where it's been hard to find the big productivity gains that we saw in the tech boom of the 1990s. Those have not been present recently.
Great, thank you. Jeff, we have a question for you. The question is, what are the entrepreneurial characteristics of the millennial cohort? And specifically, what industries do you see more entrepreneurial activities taking place?
We haven't done a deep dive in terms of sort of industry breakdowns of entrepreneurship. Historically, successful entrepreneurs are not young people because it tends to require capital and social connections, business connections to be a successful entrepreneur. So a lot of entrepreneurship actually takes place with 50-year-olds. And that being said, the millennial generation appears to be very entrepreneurial. If you go to any WeWork site or similar work sharing place, you'll see all sorts of entrepreneurial activities going on. I think it's a healthy trend. I think a lot of the entrepreneurship that's going on in non-Caucasian populations is being driven by millennials as well, but we don't yet have a lot of hard data on that. Among the millennials, it seems to be focused on tech. That's understandable. I think some of it was probably led by the people seeing instant overnight app millionaires, but I would expect it to broaden out over time. And I think entrepreneurship becomes a character trait. So even if someone is not a successful entrepreneur as a 25-year-old and ultimately goes to work elsewhere, I'm not sure that I suspect that once bitten, you are always trending towards that, and we may see that positive trend of after they build capital and connections and experience, they'll come back out with more entrepreneurial activities.
Thank you for that. Don, I'll pass this one to you, and this is actually a couple of questions along the same vein. The one question is private sector capital investment versus public sector infrastructure, or I guess that maybe education as well. So private sector investment versus public sector investment, which policy lever has the highest beta or impact on productivity? And tied to that was a question of how much would you expect manufacturing productivity to increase if capacity utilization was above 80%, and tying that into more private capital investment? You want to try to address that?
Yeah, sure. So in terms of public versus private, sometimes they're not substitutes, so they're not always in competition. There are things that don't have a cash flow attached to them. So if we think about schools or levies, these things are not things that are necessarily easy for the private sector to do all the time, because they don't have that cash flow that can provide the return to investors, but they still do have a benefit. There are public goods. There is a role for the creation of public goods. Interstate goods, highways would be an example. And so, there is, just to tack on the second part of the question, a sense in which the fact that the economy has not been running hot, it hasn't really overheated in the historical sense, especially in goods production. Look at the goods components of the inflation metrics like the CPI to see some of that. So you've been able to get by with the capacity you've had. So the level of productivity is still high. We've accomplished a lot over generations, and so the level of productivity has been elevated. It's the growth rate in productivity, the delta, where we're looking for that gain, and we're looking for that gain to pay future obligations. So nobody's saying the level of productivity is low. We're saying the growth rate in productivity is low, and that growth rate matters because of things we've promised ourselves or others in the future generations. So I guess I want to take the question and just say I think there's a role for both. I'm not convinced at all they're always in competition. We are measuring the non-farm business sector, right? Not the housing sector, not the government sector, but there are roles for both type of goods in this process, and the most successful periods historically have built on innovations that have come out of both.
Great, thank you. Very important point that the actual level is high. It's the growth rate that is we're addressing here in terms of its being subpar. Jeff, a two-part or two questions that are related to policy. One is asking how has productivity been impacted by the opioid epidemic in the United States? Are there any policy changes on that front? And then a related policy question about U.S. immigration policy. How should we think about productivity growth from both the lens of opioid epidemic and U.S. immigration policy?
Sure. I think both really speak to the concept of labor mobility, getting the right people in the right seats. The opioid epidemic tends to sound like a social issue and not an economic issue as well until you look at the numbers. HHS, Health and Human Services, estimates that 11.5 million Americans are taking opioids for non-medicinal purposes, so recreational drug use. Of those, roughly 2.1 million suffer from opioid use disorder, what we would think of as being addicts. The addicts, many of them are out of the labor force completely. So while that's not necessarily a statement on productivity, it's certainly a statement tied to overall growth. But what we also know is that many of these people who are abusing opioids are employed. And from any number of studies, we have suggestions that they are not performing at their full productivity potential. So for instance, absenteeism and more sick days is closely linked to abusers of drugs in general and specifically opioids. We also know that it precludes drug use, illicit drug use precludes people from certain industries where drug testing is a matter of either law or safety. So for example, many defense contractors, you can't get hired if you can't pass a drug test. More broadly, you have manufacturing, transportation, construction, and healthcare, where it's a matter of workplace safety. And legalization of marijuana doesn't change that. These are safety issues based on potential impairment. And although we've seen some manufacturers loosen up their standards, usually small ones, it's probably not a viable long-term business strategy. So we are suffering from productivity because we can't put people in higher performing jobs because they can't pass a drug test. In terms of policy, very difficult to deal with. We have come a long way in terms of the overprescription, the legal overprescribing that was going on. There's been a tightening. Most of this is state by state legislation that limits the either insurance coverage or limits the doctor's ability to prescribe multiple pills and being able to refill those prescriptions automatically. So we're making some progress. We'll probably see, when we get the full year numbers, we'll probably see a decline in overdose deaths. Unfortunately, this problem is not over. It's shifting from people who started with legal prescriptions to fentanyl and other very powerful synthetic opioids that are kind of going to more traditional drug abuser channels, and that seems to be spreading in the country. With regard to immigration, obviously, we continue to have a skills gap, and the sort of immigration has provided, and I say this as son and grandson of immigrants, immigration has provided enormous vitality to the U.S. economy. If you look again, I refer back to the entrepreneurship rates of the Latino population. That's one reflection of it. And then in highly skilled jobs where we have been granting visas, we could do more in the policy setting to open that up, or to go to the kind of skills-based immigration policies that are more selective and raise productivity in general. Obviously, those are economic considerations. There's a lot of other considerations when we look at it through the lens of being a citizen and not just an economic standpoint, but certainly better immigration policy, or immigration policy could be better targeted towards driving productivity growth.
Great, thank you for that. And our very last question, kind of from two different sources. It has to do with the race against the machines, artificial intelligence, and how is AI going to impact productivity. Don, why don't you go first, and Jeff, maybe I'll let you have the last word. But Don, any thoughts on AI and productivity? Any insights?
Yeah, I'm hoping for the AI. I will say that. I mean, it's not to say it won't be disruptive, but I think AI should be good. There have been changes in the structure of the U.S. economy in the past. They've helped productivity. There were times, if you go back to the 1800s, half the labor force was employed in agriculture. Today, it's 1%. But we don't seem to miss our farming jobs because the farmers that are left are enormously productive because they don't farm the farm as much as they program the farm. They have GPS tractors and massive combines and genetically engineered seed and better weather forecasts. And so I think AI is a continuation of that trend. I'd just like to see it get to business process for different companies, but I am not overly worried about a shortage of work because the unemployment rate is low right now. We don't seem to have a shortage of jobs. We may have a shortage of good jobs. We may have a shortage of productive jobs. But that's a place AI can help, and so I'd be optimistic on that front. Not overly worried about the the machines. I want the machines.
Jeff, what's your take?
I, like Don, too, welcome our new robot overlords. But one thing I guess I would caution is we've had massive innovation and massive new technologies for centuries, particularly in manufacturing. And it has contributed to American productivity, but it may not be this earth-shattering shift higher in productivity that some people expect. And I always ask audiences to think about their cell phone and how transformational the smartphone has been, and yet our productivity overall in the economy has not been roaring ahead. And people like Don referenced earlier, Robert Gordon at Northwestern, argue, and I think this is an overstatement, but that the best productivity gains are behind us, because everything we're talking about, including AI, is inconsequential relative to electrification or the introduction of the steam engine or railroad transportation. I think that's an overstatement, but there is some truth to it that we should keep in mind that AI will help productivity, but it's not going to lift us to 4% productivity gains across the economy. It's just yet another in a continued transformation and innovation in the U.S. economy that supports productivity growth, just like it has in the past.
Terrific. Well, thank you both, our panelists, Don and Jeff, for your insights and participation today. Very informative, and I think you've really helped to put this question about productivity growth to frame it in the right way. I want to thank all of our participants and listeners. Thanks for the excellent questions. If you have another question that we did not get to or you think of later, please forward that to GIC contact and we will respond to you directly. Thank you, everyone, for your participation. Have a great day.